It is gone. This is the IssuesWatch podcast. Hello, and welcome to the IssuesWatch podcast. I'm Brad Muniz, your host for the bi-weekly accounting and auditing episodes. I'm an insurance partner at Clifton Larson Allen. This episode qualifies for Nano CPE credit. If you're interested in earning CPE credit for this episode, hit the pause button now and head over to njcpa.org/nano to find out how. A quick disclaimer, the views and statements expressed herein are my own and not necessarily those of NJCPA or CLA. Okay, so we've got really only two topics we're going to cover today, and the first one is going concern, hence the cold opening. So why am I talking about going concern? Because we're looking at the economy. They're always talking about potential recession coming up. You have to keep this in mind always. Let's real quick, and now I'm going off of a presentation that Frank and I have done, and I've done at many different chapters. So if you see me looking at some papers, that's what it's coming off of. And we're going to try and provide some show notes to you so you can click on some of the content. The going concern is a basic assumption of the underlying assumption of accounting. So this is just general, covers all financial statements. And you'll hear me make a comment later on. This is not just GAAP, okay? It's for a company to be a going concern. It must be able to continue operating long enough to carry out its commitments and obligations. In other words, the company will not have to liquidate or be forced out of business. If there is uncertainty, the company has the ability to meet the going concern assumption. The facts and conditions must be disclosed in the financial statements. In the financial statements. So ASU, Accounting Standards Update, came out around 2014 and put this responsibility on management. It used to be only the auditor's responsibility. It is management's responsibility. It's management's assertion that there is an ability for the company to be a going concern, meaning that it will have the ability to meet its commitments and obligations. Okay? Substantial doubt about a company's ability to continue as a going concern exists when conditions and events considered in the aggregate indicate that it is probable that the entity will be unable to meet its obligations. Okay? When conditions and events, I know it said in the aggregate, but when conditions and events indicate that a company will not be able to meet its obligations. So that's where the difficulty comes up. I, as an auditor, regularly face a situation where we identify conditions and events and we say we have a situation where we have to address the ability for going concern. So what are the type of conditions or events? I will tell you as a QC person, there's many of them, and in the show notes you'll see examples that's even provided in the ASU. But I will tell you as a QC person, I look at 4 immediate items, and if those 4 come up, you should anticipate that other readers may see this. And it might be other readers that don't have enough information, but they're still seeing this, okay? And the 4 that I see, well, the first one that's an example is negative financial trends. That's the first example. So the 4 negative financial trends that I usually just look for as I'm reading financial statements are a negative working capital, recurring losses, negative equity, and negative cash flow from operations. Now, you could have a year of a loss, and that doesn't mean automatically that you're a going concern situation, because you have to look at multiple factors. But those 4, right off the bat, I, as a reader of the financial statements, look and I say, remember that little, ooh. Now, I know you as management and your financial statements, you're very sensitive. It's almost personal to you that this is a possibility. You have to take a step back because you're very involved, and you have to say, what is the reader seeing when they're looking at these financial statements? And they may not have all that other information. And I'm going to talk about that a little bit more in a second. But remember just those 4 real quick. Negative working capital, negative equity, recurring losses, negative cash flow from operations. Quick and easy items to see. There are other indicators, default on loans and similar arrangements, internal matters and others, work stoppages, and other situations such as legal proceedings. Now, we originally started doing this presentation when COVID hit, because that was another indicator that came up. So when management, when it has determined that there are indicators, okay, which is usually the starting point of the disagreements and the pushback that we get, when there are indicators, management has to determine if they have the ability to mitigate the substantial doubt for a going concern. And ways that you can indicate it is you can have a forecast to show how you're going to meet your obligations. As an auditor, you have to be able to audit that forecast, and it's not just refooting the columns. You can be refinancing a loan. If one of the reasons you're a going concern is you have a term loan that's ballooning and you have a big payment next year, well, you have to show that you have the ability and the intent, and the ability isn't just, we're talking to banks. You pretty much need an agreement with the bank to be able to show that you have the ability. Now, of course, I'm being very generic here, but we only have 10 minutes to talk about this. This is usually a 1-hour webinar, seminar that we do. You have to be able to find indicators. Now, if you, either way, if there are indicators, you have to have disclosure as it relates to potential for or threat to going concern, okay? You have to indicate the principal conditions or events that raise substantial doubt. You have to discuss management's plan to an evaluation and plans to address those, and if the plans either alleviate or don't alleviate that substantial doubt. Either way, if there are indicators, you have to have some disclosure in your financial statements. Now, as an auditor, if there are indicators and they are not alleviated, you should have an emphasis. You have to have an emphasis of matter paragraph. If there are indicators and it's not alleviated, and it is alleviated, you can have an emphasis of matter paragraph. You don't have to. But if there is a going concern situation because the events or conditions are not alleviated, you have to have an emphasis of matter paragraph. Either way, management, you have to have some disclosure as it relates to this. This is an assertion that you're making that the entity is a going concern, meaning it'll meet its obligations. Okay? If not, if there's indicators, you have to address it, okay? The reason why I'm talking about this a lot is I was just dealing with this with a client, and they kept saying, no, come on, we have a related party, or we're part of a group of companies, and the group of companies can support us. And I said, well, the reader doesn't know that. Well, we say in here that we're part of a related company, that the companies support us. I said, I understand that, but the readers don't know that the other companies don't have that ability. Management is very invested in this, and they have a lot more information, but you have to give the readers some more information. That's what this is all about, is providing adequate information. So we talked about the audit, just about your reporting. If management refuses to do an evaluation, you could have an adverse condition, or you have a scope limitation because they're keeping you from doing audit work. If management refuses to report on it, or disclose it, you could have adverse situations, okay? So this does have significant impacts. It doesn't limit, I kept mentioning audit. This also falls under review. The review standards were changed, and the review accountant should include an emphasis of matter paragraph if it is a going concern, okay? That was changed a while ago. The big one that I always get is compilations, though. What happens if it's a compilation? Well, if it's a compilation, you still have to consider this, because as we said before, this is a basic presumption of an entity's ability to meet its obligations and what you should know is the term is for a year of the issuance of the financial statements. Not the year of the balance sheet, a year for the issuance of the financial statements. Okay? That it goes through audit, reviews, and comps. And there should be disclosure. Aha! What if there is if this is a comp no disclosure? Well, they say, listen, you can't force them to disclose it, but the guidance gave some comments and said financial statements may be misleading. For example, if applicable financial reporting framework includes the premise of financials are prepared on a going concern basis. In other words, if you don't address this and just leave it blank and silent, a reader may think, wow, this is the company is a going concern, and which means it'll meet its obligations. If all of a sudden they then go under or something happens, guess who they're going to look to? You as the accountant that did the compilation say, how come this wasn't addressed? Now, I had talked to a malpractice provider, and I asked them what they thought about this, and they said, absolutely. If you have a comp with no disclosure and you know it's a going concern situation, you should ask management to report it. And what we've done is we've done selective disclosures. So just consider that. One last thing I want to go over real quick, risk and uncertainty and concentration of credit risk. Okay, why am I bringing this up? Well, let's talk about Silicon Valley Bank and Signature Bank. Remember, your financial statements are supposed to discuss the cash concentrations. And I'm putting aside any political commentary. You don't need to give me any comments, anything like that. Forget about if the banks are being supported and if all the deposits are being satisfied. Put that aside. Either way, you know that your financial statements with disclosure are supposed to be addressing concentrations, and one of the concentrations that's regularly disclosed is the cash balances. Now, most financial statements I see that at various times the company has cash in excess of insured limits, and it leaves it at that. And there's always discussion about what type of disclosure you have. I just had a discussion yesterday with somebody, and they said, oh, we put the amounts in there. I'm like, what amount do you put in? Do you put the cash balance on the books? Do you put the cash balance on the bank? Then people are going to say, what's the reconciling difference? Or is it more important that the amount as the dates the financial statements are being issued? It's unclear what people are doing, what exactly has to be there, but just keep in mind that you have to have some sort of disclosure to release that, especially with this banking situation that we've been seeing lately. Okay, so a few closing notes. Join me, Frank, and lots of other amazing speakers at the NJCPA Convention and Expo, June 13th to the 16th in Atlantic City. You can earn up to 20 credits, plus New Jersey Law and Ethics course if you haven't completed it this triennial. Go to njcpa.org/convention for all the information. Early bird pricing is in effect through May 1st. There are some other up-and-coming in-person A&A events being held by the NJCPA chapters. On April 25th in Clark, the Union chapter is offering an A&A update. On May 4th in Cinnaminson, the Southwest chapter is holding a nonprofit update. On May 16th in Patterson, the Passaic County chapter has a program on data analytics. Get the details and register at njcpa.org/chapters. Last but not least, be sure to join the NJCPA Accounting and Auditing Standards Interest Group. Sign up for free at njcpa.org/groups. Thank you for watching or listening.